We are going to go through PacWest Bancorp's 10K, and we're specifically going to look at investments. We're going to look at available for sale debt securities and held to maturity debt securities as well. So we want to look at the balance sheet to get a better understanding of what is going on with these investments, because in this rising interest rate environment, this is crippling these banks, especially if they have major withdrawals from depositors and they're forced to sell any of these investments to come up with cash for the depositors. So let's look at let's jump to page 47. We're going to look at the management's discussion and analysis of financial condition. They're highlighting items on the balance sheet. So first thing I'm looking at, I got securities available for sale. You got about 4.8 billion of available for sale securities. Then we have securities classified as held to maturity. You got about 2.3 billion of those investments on their balance sheet. And then you got the big one here, loans and leases held for investment, 28.6. They're a bank, of course they're making loans, that's their business. But we're gonna look further in the financial statements. You can see where this loan number is definitely inflated compared to what it's worth. Now, I do want to acknowledge they are putting on an allowance for credit losses. Now, this doesn't necessarily relate to the interest rate environment. This relates to the loans and who owns the loans and where they think they might come up short on bad debts of loans just not being repaid. So they do have this note in here. The company did transfer 2.3 billion in fair value of muni bonds, commercial mortgage-backed securities, private label commercial mortgage-backed securities, U.S. Treasuries, and corporate debt from available for sale to held to maturity. Basically, they reclassified some of these debt investments from something that gets marked to fair market value to something that just gets held at cost. I'm not sure that this is a big deal. It might come across as a big deal, but I think they're just looking at their facts and circumstances and they're saying, hey, we plan to hold these for the long run. We're going to follow the accounting guidelines and we're going to classify these as held to maturity instead of available for sale. So page 65, they break down the held to maturity debt securities, the investments of the 2.3 billion. And the largest category is going to be your muni securities, which is about 1.2 billion of assets. They actually are not holding a ton of U.S. Treasuries and held to maturity securities. They're only holding 184 million. I know that seems like a really big number, but if you compare it to their overall balance sheet, it's not a huge number. They have a bunch of mortgage-backed securities in this, and they have some corporate debt securities that make up this 2.3 billion. So if we jump to page 88, there's a little bit of irony in this footnote, and I have the benefit of hindsight here of what's currently happening, but I'm just going to read it to you, and I think you'll understand where I'm going with this. So, the ability to have readily available funds sufficient to repay fully maturing liabilities is primary importance to depositors, creditors, and regulators, of course. The company's liquidity, represented by cash and due from banks, interest earning deposits in financial institutions, net of restricted cash collateral accounts, unpledged available for sale securities, unpledged held to maturity securities, is a result of the company's operating, investing, and financing activities and related cash flows. That's just a way of saying, hey, we've got investments that we can turn into cash in the event that depositors are withdrawing funds or creditors or regulators need that cash. So let's continue going on through this. In order to ensure that funds are available when necessary, the company regularly projects the amount of funds that will be required over a 12-month period. That's normal for any sort of accounting, finance, CFO position. It also strives to maintain relationships with a diversified customer base. Liquidity requirements can also be met through short-term borrowings or the disposition of short-term assets. Interesting. The company has a formal liquidity policy, and in the opinion of management, its liquid assets are considered adequate to meet cash flow needs for loan funding and deposit cash withdrawals in the short term. Holy cow, it is May 2nd that I'm recording this, and that statement is not aging well. Let's continue. Page 161. This is notes to consolidated financials, and we got a table here reflecting the carrying value of the assets that are on the balance sheet. So we're looking at the securities held to maturity, and we're also looking, I also want to look at these loans and leases held for investment. you could start to see what's happening even at the end of the year of interest rates increasing. Securities held to maturity, carrying amount $2,269,000,000, and it's saying the estimated fair value at 12/31/22 is $2.1 billion. I mean, this is not an ideal situation to have a $158,000 unrealized loss not in your financials, but when looking at Silicon Valley Bank and First Republic Bank, they had much larger discrepancies or much larger unrealized losses related to held to maturity investments. Let's continue, because then I see the doozy of a number as we continue going down. Loans and leases held for investment. They have a carrying amount of $28.4 billion, but they're saying the fair market value as of 12/31/22 is $26.6 billion. Now that is a $1.7 or $1.8 billion unrealized loss on those loans that again are not reflected in the financial statements. They're held at cost because they're assuming that these loans are going to mature. Now they are being anticipated credit losses, but that's pretty small compared to what the rising interest rate environment is doing to the value of these underlying assets, because these underlying assets are yielding, or the interest that they are paying out is so much lower than the current interest rate environment. And if they're forced to sell these, this is where a lot of banks are getting in trouble. If they're forced to sell them, they got to sell them at these losses, and they're incurring these losses. And if they don't have enough funds or excess cash to return cash to depositors, this is where you're running into situations where FDIC or the government stepping in and selling these banks to other banks. All right, we have our second statement in this 10K that I stumbled on that just did not age well. I'm sure they had this intention when they did the audit, but page 126, although we periodically sell securities for portfolio management purposes, we do not foresee having to sell any impaired securities strictly for liquidity needs, and believe that it is more than likely than not we would not be required to sell any impaired securities before recovery of their amortized cost. That was a mouthful of saying that they are not intending to sell any of their held to maturity securities. I have no idea if they did, but judging by the news and the fact that their stock is plummeting, they probably had to. And as a result of that, they're taking the losses. They've lost the money in that situation. And just not a good situation. All right, that's PacWest Bancorp's 10K looking at investments held to maturity and available for sale. I hope this is the end of me looking at banks' balance sheets and their investments. I'm not enjoying all these banks and the situation that they're in, but I hope you learned something. Hope you got something out of this, and have a good rest of the day. Take care and goodbye.